the one question most investors want answered with Apache, and why the company will struggle until it is. Where the company made an early mistake with Alpine High and continues to pay for it. Whether or not its low share price represents a good entry point. Source: Seeking Alpha. For some investors that nominally follow Apache Corporation, NYSE, APA, there has been some consternation as to why it hasn't enjoyed the boost in oil prices in a similar way its peers have. While Hurricane Harvey was something the market and management couldn't foresee in 2017, even after the earnings report for the first quarter of 2018, where the company surpassed expectations and raised its production guidance primarily based upon its output from its Permian Basin assets, it still failed to gain traction. In this article we'll look at the key thing the market wants to hear from the company, and why Apache will struggle to gain momentum until it is able to deliver on those expectations. Alpine High. In managing expectations from the beginning of the time of the announcement of a huge reserves discovery at Alpine High in the Delaware Basin, Apache has endured a lot of skepticism from the industry in general, and many investors in particular. The major reason for that is the region had been gone over fairly well in the past, and it was considered dubious that the company had managed to find a jewel the rest of those exploring in the area for years had missed. So when the announcement of the discovery was made, there was immediate responses concerning the accuracy of the amount of oil considered to be located in Alpine High, which remains to this day, as the company slowly develops the resource. Apache estimated that the acreage had approximately 75 trillion cubic feet of mostly wet gas and 3 billion barrels of oil in the Barnett and Woodford regions of the field. It also said there is significant oil potential in the shallower Pennsylvanian, Bone Springs and Wolfcamp formations, that represents about 15 billion barrels of oil and gas. Another element that was a key to the legitimacy of the narrative was that Senior VP of North American Unconventional Resources, Steve Keenan, was a major figure in the discovery. At the time he worked in the industry for 38 years, and had come from EOG Resources, where he was an integral part of that company's success. Since Apache management hadn't, for the most part, participated in the early years of the shale boom, the combination of hiring Keenan and a potentially big discovery of major reserves, in my opinion, caused the company to poorly manage expectations, as they announced the amount of oil drilled with 5 new wells in early 2017 produced about 25% oil on average than prior wells that had been drilled. After the results of the evaluation wells were announced by CEO John Christman, some said there was a misunderstanding concerning what was communicated concerning the 5 wells. He attempted to walk back his statement in the sense of offering clarity concerning the reasons behind what was considered disappointing results by analysts, saying reason for the decrease in production was because of a lack of equipment and pipelines in the remote area, which has limited hydraulic fracturing operations and the amount of oil and gas that can be extracted, even though I think the company has done a poor job. Combination of weaker results and ongoing skepticism, which remains to this day, was enough to cast further doubts on the amount of reserves that are in Alpine High. That's especially true with how much oil is really there. What the market wants to know with Alpine High is how much oil there really is in the acreage. Until that is answered, I see Apache remaining under pressure with its share price. Low costs at Alpine. In the past, Apache has stated that investors should monitor Alpine High progress on 3 key fronts: well cost reductions, well productivity, and inventory expansion. Based upon the share price of the company, investors aren't taking heed to what Apache wants them to focus on. For example, concerning cost reductions, in the first quarter the company said it cut cost on average by 20% over 2017. It has a goal of reducing costs by 25% over 2017, so it's well on its way to achieving that goal. It shouldn't have trouble meeting the remaining 5% by the end of 2018. It also reported lease operating expenses, low, dropping significantly in the quarter, dropping to $4.50 per barrel of oil equivalent. Apache said it wants to cut that to under $3 per barrel of oil equivalent by the end of 2018, and by the end of 2020, have costs under $2 per barrel of oil equivalent. The company cited the reasons behind the low-cost structure as the transgressive source interval in the Woodford, Barnett and Penn, Pennsylvania produces very little water, resulting in minimal handling and disposal costs. Another factor in lowering costs is the increase in the number of wells drilled, which as they grow in number reduces costs per well. At the end of the second quarter of 2017, Alpine High had 11 wells in production, with another 17 waiting to be completed. Of the 11, 5 were constrained to control flow as we commissioned newly installed equipment and evaluated initial reservoir performance, and the remaining 6 wells were in various stages of flowback and testing. On the well side, all-in costs are in a range of $4 million to $6 million each. Some of the catalysts for cost reduction are these: we are utilizing a sputter rig to set surface casing in an effort to reduce shallow hole cost associated with high-demand larger rigs. In addition, we have been successful in the elimination of the casing string in some areas, and reduced drill time in the intermediate and lateral sections of the well. CEO John Christman said in the 2017 third quarter earnings report that individual rigs at Alpine High are self-funding in under 2 years. While all of that is a positive in my view, the fact is the market, in general, isn't rewarding the company for it. When examining well productivity and inventory expansion, that isn't getting investors excited either. The point is that there is one thing investors want to know, and that is how much oil is being produced at Alpine High. The rest is secondary to the market. Oil production: the market gave a yawn when the company reported record production in the Permian Basin, which resulted in overall production guidance being upwardly revised for the second quarter and full year 2018. Production in the Permian Basin jumped 19% year-over-year. Guidance for international output remained the same, even though being leveraged to Brent oil resulted in an improvement in margins, higher cash returns, and strong free cash flow. In June 2017, sales from Alpine High came in at about 7,400 barrels per day, with oil and natural gas liquids accounting for 10% of the total. The reason given for the low liquid content was that the area being drilled has primarily been lease retention focused, and these wells are generally deeper. For the first quarter of 2018, output at Alpine High averaged 26,300 barrels of oil equivalent per day. The company was able to reduce costs at the wells from over $8 million per well last year to $6.4 million in the reporting period. For all of 2018, costs are expected to average about $6.2 million per well. Even with the meaningful increase in production, the market still isn't impressed because of the mix coming from the well, which is low in oil. Conclusion: since Apache Corporation is trading at a decent value at this time, and production is climbing, the question is whether or not this is a good time to take a position in the company. To me, it would depend on the investing purpose. If it's for income, then this could be a good entry point, as it'll without a doubt eventually climb in price, so the risk in that regard is low in my opinion. That said, the price of oil has soared and the company, in spite of numerous optimistic remarks about the oil potential in Alpine High, has yet to deliver. If the price of oil drops and Alpine High disappoints with the amount of oil in the play, it could put a lot of downward pressure on the share price of Apache for a prolonged period of time. The market is waiting for confirmation on the mix of oil in Alpine High, and until that is visible, I think the company will continue to struggle to find price support for its shares. After all, if soaring oil prices aren't enough to support the company's share price, it's obvious the market is waiting for the results coming from Alpine concerning oil. If it does hold the amount of oil it believes is there, the share price of Apache will soar. With the uncertainty surrounding that, it would be better to take a smaller position in the company at this time in my view, as it would lower risk. With the deliberate way Apache is working Alpine High, I don't see any big surprises on either side of the play, as it's going to unfold gradually, rather than the company going all in. That would change if it does find oil becoming a larger percentage of the reserves. Until then, I don't see a positive catalyst that'll drive this company in the short term. Further out, once Alpine High is developed more, the market will have a more visible outlook on what to expect from the acreage. At that time I think, even if it isn't as good as expected, it'll give investors a clearer understanding of what to expect, and they'll start to look at other acreage Apache is developing, and probably drive up the share price from those assets, assuming oil retains some of its support going forward. If Alpine High performs as management optimistically believes, the combination of its various plays will generate some nice returns for investors. Disclosure: we have no positions in any stocks mentioned, and no plans to initiate any positions within the next 72 hours. I wrote this article myself, and it expresses my own opinions. I am not receiving compensation for it, other than from seeking alpha. I have no business relationship with any company whose stock is mentioned in this article.